In this video, I'm going to take you through a simple, but what is, in my opinion, the most effective approach when it comes to trading strategies. Hello, I'm David Jones from Capital.com, and this is the latest in our series on how to trade Forex. Now, that statement at the beginning is quite a bold one, that I'm saying this is the most effective trading strategy, but I do really believe that. I think one of the problems with trading, particularly when you first start, is it can be incredibly complicated. There are so many indicators. You can get bogged down in looking at so many different things that you can't see the wood for the trees. So in this video, we are going to cut through all of that. So what I'm talking about is looking at the idea of trading off support. And I think there are a couple of reasons why it's such an effective approach. First of all, it gives you a logical area to look at getting into a market. Secondly, and arguably more importantly, it gives you an obvious signal when you're wrong, when to get out your trade, so you can see very clearly where to set the stop loss. And finally, it can stack up some very good risk versus reward opportunities. So to find out what I mean by all of this, we'll have a look at the theory, then we'll look at some real world examples, a couple of which I've traded in recent days. So let's get into it. So let's take a look at this idea of support and how it's formed. So put simply, it's just a previous low, a level that the market has fallen to, and then we've seen it recover. It's bounced back. And you see these over all sorts of time frames. Longer term charts, medium term charts, very short term charts. You will see these support levels, previous lows where the market's fallen. So let's say a market is trading at 1,000, then sentiment changes, the market slides, gets as low as 900, turns around and recovers back to 1,000. Clearly, the negative sentiment in the market changed at 900. The market sold off from 1,000 but turned around at 900. So at 900, sentiment switched. So at this level, the market was perceived as cheap, for want of a better word, or offering value. So the buying power overcame that selling pressure. The market turns round and rallies. 900 is left as support. So how we use this as traders, the assumption is that levels that were important in the past will be important again in the future. So how can I use support as a trader? It gives you an obvious zone to watch for an entry point. In a second, we're going to look at a few examples and you'll see how it plays out. But arguably more importantly, if you're trading using this approach, then it is very clear where the stop loss should be set. Rather than just choosing a random figure 20, 30 points away, you've got an absolute level where if that level gets broken, the reason for the trade has gone. Let's take a look at some examples. I've started with a really short-term example here. This is the pound against the dollar. The reason I've picked this is because it's something that has been happening at the time of recording. So this is all happening in the last week of March, and we can see March the 25th. We can see here the pound sells off early in the morning against the dollar, trades down to about 131.60. Then over the next hour and a half, the market rallies 60 points up to 132.20. So at the moment, looking at this, there was no way of knowing the market was going to turn around here at 131.60. But look what happens over the next hour and a half. We come right back down towards this 131.60 area. The market trades as low. It's about 131.63 and then starts to turn around. An hour later, the market's coming back there again. So if we were looking to buy the pound against the dollar on a short-term trade, this is an obvious place to think about getting in. Maybe we'll be a buyer now at 131.67. We know 131.60 is support. We want to give the market arguably a bit of leeway. So let's say we're going to put our stop loss 20, 30 points below that level. So we're assuming that this 131.60 area is going to hold again. But if we see a sustained push through 131.60, we're going to get out. We're going to take the small loss on the trade. Let's jump forwards and see what happens. We did end up getting quite an extreme move in the end. You can see once again the market turns around. So 31.60 proved to be the floor. We get a 70-point rally off that. And we're still really within a few hours of setting that support earlier on. But let's say you'd missed all that. Let's jump forwards again. So for the next few hours, nothing much happens. The market's very volatile, but we don't see much in the way of a directional move. But later on in the day, you can see just at 4:30, so towards the close of the European session, the pound drops again, drops back to this old support. So again, an approach here, if we're using that support as our entry point, we want to be a buyer. The market, I've stopped it here at 131.78. We want to be a buyer. Again, our stop loss should go the other side of that low. Let's walk forwards. Over the next hour and a half, nothing much happens. The market did push a little bit lower, but doesn't take out that earlier 31.60 level and pushes a bit higher, but it's fairly quiet. Let's walk forwards again. Over the next 12 hours or so, the market once again moves away from that 31.60, 31.70 area, rallies 50 points. So again, the support is held. One last look at this market. It's the next day. It's just after 9 o'clock in the morning. Again, we're back down to 31.60. Don't forget, this is all happening over a 24-hour period. You can also see it on longer term timescales as well. I'm using this because it's something that's happened just over the last few days. So again, if we were looking to be a buyer here, we've got an obvious place to buy. We're going to buy at 131.69, 131.70. We're going to put our stop loss the other side of 131.60, let's say 131.40, something like that, and just wait to see what happens with the market. So pound against the dollar does push briefly below that level, but our stop loss is 20 points below, so we're going to wait and see. And once again, we get the big move. So if we're trading pound against the dollar over the last couple of days when I was looking at this, there's a really obvious level to be a buyer. We've got no interest in buying in the middle, buying at 132, because for me, my stop loss would still need to be the other side of here. But if I see weakness towards those low 131.70s, 131.60, it seems like a great place to get in terms of risk versus reward and having an obvious place to put my stop. So just to show this works, or you'll see it happening over all sorts of time frames, here's the price of gold from August 2018. That's when we saw the low made in gold around about 1160. And since then, the story for gold has been one of continued recovery. It's made a great start so far to 2019, pushing as high in February as about 1340. So this is the market that we regularly look at on the live streams we do during the week that you can watch from our YouTube channel. So we'd seen the market push higher. Of course, no market moves in a straight line. Let's take a look at what happens when gold starts to correct. So we've seen quite a big sell-off so far from above 1340 back below 1300. We have gone crashing through this old support here, so didn't really think about this old support on the daily chart. But the next big level to watch, the lows for the year so far. So this is all happening beginning of March 2019. All the way through January, we saw the price of gold hold around about 1275. Let's pick that up. So there's our support, around about 1275, 1276. It was the lows for the year so far. It's the low from a couple of months ago. So it could be potentially an important level. So if we think the trend for gold is still up at this point, which it is, I think, looking at that chart, for me, one area to think about being a buyer is ahead of this old support and having stops the other side, maybe around about 1268, 1270, something like that. Let's walk forwards. So don't forget, these are daily candles, and so far over the last 4 days we have seen gold hold above this old support. So we're back to an area where we'd seen buying in the past, where we'd seen sentiment change, and so far we're seeing the same thing happen again. So one potential trade here is to be a buyer. The market is about 1286. We have our stop loss somewhere the other side of that 1276, 1275 level. And we wait and see what happens. So it's giving us a really obvious place to put our stop. If it breaks through here, we get stopped out for a small loss and we wait to see what happens a bit lower down. But let's say we buy in here. Let's walk forwards. And the trend resumes. So far, we have seen that support hold. So even though it's trading now at the time of recording at about 13, 14 an ounce, if we did see weakness from here, the level I'll be watching again, it's that old support down here at 12.75 and now 12.80. So it shows how these levels, although they don't work all the time, they can give you an obvious point to think about buying into a trend, and also where to set your stop loss when it comes to managing risk. And just to show it doesn't work all the time, here's Euro US dollar. So this is Euro dollar. This is an hourly chart we've took on the lows in March 2019. The market's traded up as high as 114.45. A bit of support left over the previous days. So March the 20th, March the 19th, traded down to 113.38. The next day as low as 113.35. So 113.30, an area to watch on Euro US dollar. It's currently trading at 113.77. So we might be waiting for a pullback and looking to buy in with stops the other side of this level. Let's see what happens next. Here we go. Euro US dollar goes sailing through those previous lows, that old support. So it didn't care that this was old support. I think this was in reaction to some German manufacturing data. But just to illustrate, it doesn't work all the time. If we had bought in here and had stop losses the other side of that support, we should be out for a manageable loss. And for me, this is probably the biggest benefit of trading off levels like this. You definitely know when you're wrong. You can quantify your stop loss. You can come out quickly if you're stopped out and move on to another trade. But when it works, it's a way of finding logical places to enter a market without just randomly jumping in on short-term moves. So there you go. It's hardly rocket science, but I think we do forget that, so much of markets is just supply and demand. Markets trying to find areas of value, areas where it's overvalued or undervalued, and market participants reacting accordingly. I think that the best support levels are the ones that jump out at you straight away, like that example we saw in the pound over the last few days, plus the example in gold, the lows for the year around about 12.75. So next time round, we'll look at the flip side of trading this. We'll look at the idea of selling near resistance. Similar principles, of course, we're just taking a different position. So make sure you're subscribed to never miss out on any of the content that we produce. If you have any questions, leave us a message in the comments below. And if you do subscribe, just click on the notifications icon down there, that bell thing, and you get notified every time we upload new content. But for this latest part of our trading course, we'll wrap things up there. So from me, David Jones, and Capital.com, good luck with your trading.